So in order to compare these two strategies in a more decent and clearer way, I construct a super investor index. It contains 8 super investors that I found in Guru.com. These investors are managing mutual funds in a value-oriented approach, and they achieve the compound annual return of at least 1% better than the S&P 500 over the last 20 years. I take the arithmetic average return of annual returns, and it is the super investor index. Let's take a look at the annual returns of super investor index relative to the passive indexing investment. Super investors do not necessarily outperform the market in each individual year. However, during the period between year 2000 and 2002, 2008, and 2011, there is an obvious axis return of super investor index. These two periods are dot-com bubble and recent financial crisis, respectively. This is, I think, to some extent shows that value investing shines in a declined market. Just as Buffett said, it's not only when the tide goes out that you know who's been swimming naked. When the overall market is strong, profitable investments are easy to come by. People don't care about whether the company they invest in is making money or not. But when the overall market is weak, only investors with high margin of safety will survive. In the internet bubble, for example, Warren Buffett bought stocks in energy industry or manufacturing industry which have higher intrinsic value, but there was not a technology stock in his bunch. Here is the compound annual return over different time horizons. These figures typically show that the super investor index has higher compound return than market in long term than it is in the short term. This is another notable feature of value investing. Value investors are likely to prefer less famous or out-of-favor companies, so it may take longer to come to realize value. Over the long run, stock market is a weighing machine, so that prices tend to reflect the fundamental developments. This finding is not coherent with the efficient market hypothesis, which suggests that no strategy should outperform the market over the long run. The rolling return reinforces the idea that super value investors can beat the market in the long run. The 3-year rolling return figures also shows that in the downturn of market, value investors perform better than market. One interesting thing I noticed when I compute the standard deviation of the rolling return is that although super investor index has lower standard deviation than S&P and Wilshire 5000, its standard deviation is higher than Russell 2000. I didn't expect it because I think Russell 2000 is a small cap index, so it should be more volatile. So, in order to find the reason why I compute the downside deviation, because for value investors, the upside fluctuation of stock price is actually what they want, because for the investors that means gain. What is risk for them is the downside fluctuation. So I calculated the downside deviation to see whether super value investors has more downside risk than the market index. And the result tends to be that super value investors actually has less downside deviation, both in the 5-year rolling return and the 10-year rolling return. So this result gives us the conclusion that value investors actually performs better than the market index, though the overall overall standard deviation of the super value investors is higher. That is basically is the result of the more volatile fluctuation in the upside fluctuation. So I think this shows that super value investors actually performs better than the market index. This is the comparison between cumulative returns. Given non-enough investing horizon, super investor index will outperform the market. Like in this graph, like say from year 10, we could see that the super investor index is higher than the rest of the three lines. So this is the return analysis for the value investing and the indexing performance. We could actually compare them in another perspective, efficient frontier. As we talked about before, the portfolios lying on the efficient frontier are the optimum ones that adjust the volatility and returns in the best way. So, in the best way. So that means any portfolio should be on or inside the efficient frontier. If we can find one lying outside the efficient frontier, we could say that the portfolio of the curve of the portfolio is not efficient. I treat S&P 500 as an index fund, so this fund is one portfolio that includes 500 US public traded stocks and it is market cap weighted. In order to construct a frontier, I had Barclay US Aggregate Index as the second portfolio, which represents the US bond market. So using the expected return, the return volatility, and the correlation between S&P 500 and AGG, I could do the optimization to plot the frontier. When we look at frontier, so all the portfolios in this